Hello and welcome to this video. The past years have been very challenging for investors, and due to this, for me personally, I have made a solid commitment to myself that I will help all my viewers who are getting started in their investment journey and even those who want to take their game to the next level. So I want to help all my viewers in navigating the stock market, which can be very emotionally challenging, overwhelming, deceptive, and sometimes counterintuitive. Due to this reason, I am making this video so that you can have the framework which is going to help you in not just surviving but thriving in these turbulent times where the market is very volatile. Even though this video alone won't make you an investment mastermind or an investment genius, but will help you in seeing things through the lens of pragmatism and emotional control while avoiding the mistakes which I made when I was a beginner, and trust me, it cost me a lot of money. I wish I had seen this video over 14 years ago when I started my investment journey. So it is my promise to you that this video will put you on the right track and help you in investing the right way during the volatile market conditions. In this video, I will give you 6 great insights which are derived from the teachings of world's best investors, and I have personally benefited a lot from these over the last 1.5 decade. So first of all, you must have an emergency fund which will help you in a situation of a medical bill that pops up due to a sudden illness or some event such as, for example, you lose your job, or which will cover any other urgent need. This is the money which you should not invest at all, since when you need it, the stock market might have drained your capital due to some event or market sentiment, and at that time you will have no other option but to take the loss. So it is very important, since in my investment journey I will tell you from my own personal experience that I overinvested a few times and bought the stocks with money that I should have not allocated to the purchase of stocks and rather kept safe for an urgent need. That resulted in me selling the stocks at lower prices since I needed the money, and in this way I made my paper losses real. This is not what I expected. I expected that the stock market will go up and it will keep on growing my money. Remember that the markets don't owe us anything, and they can go up and down contrary to what we think in a short term. So having an emergency fund therefore caters for our needs in case of unexpected events, and that is very important. So first of all, you should have an emergency fund, and secondly, you should never invest the money which is in your emergency fund. And the second insight is the power of index funds and how they give us enormous growth and peace of mind. So for many people, when they start their investment journey, or people who are already investing in the stock market, they always ask one question to themselves: which stocks should they buy? So it is a very broad question. It is like saying, which clothes should I wear today? But of course, when it comes to clothes, our inspiration mostly comes from the best designers in the world whose designed clothes act as reference points whether we admit it or not. So the area of investing is no different. Just like we have some outstanding designers, we also have some masterminds in the investment world too. The best thing is that their advice is available in the form of books and interviews and costs way less than the dresses designed by designers. So one of the best designers or masterminds in the world of investing is Warren Buffett. He started from nothing and has created an empire of 80 billion US dollars, and just 1000 US dollars invested with him in 1964 would have converted to 1.5 million US dollars today. So, as we can see in his interview with CNBC, the best thing which a person could have done on the 11th of March 1942 when he bought his first stock would be to just invest in index funds and not wasting any mental energy and time by getting drowned in the headlines of news articles, market sentiment, and even price charts.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to. and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be.
So investing in index funds simply removes the stress about which stocks we should buy and when should we buy it, because we can just simply invest in index funds via dollar cost averaging. So as he states in his interview, would you believe that if someone had invested $10,000 in an index fund such as S&P 500 back in 1942 and reinvested the dividends from that, it would have accumulated and become 51 million US dollars at the time of the interview. So what does an index fund actually mean and what is S&P 500? So an index means a list and an index fund is a list of companies. So any index fund consists of a list of companies either in an industry sector or in a certain country or region. So when you invest in an index fund, your funds are distributed across all the companies of the index fund. So essentially, as the saying goes, don't put all your eggs in the same basket. Think of each stock as an egg and the basket as a company. So in the same way, we don't want to invest all our money into the stocks of just one company. So if one basket falls, or in this case, if one company goes bankrupt or does not do well for many years, the other companies in the list will compensate for that loss. So if one basket falls out of our hand, the other basket will still have our eggs unbroken. So now we know that an index is a list and an index fund is a group or a list of companies, and S&P 500 is a list of 500 largest American companies, for example Disney, Tesla, Microsoft, Johnson & Johnson and many others. Therefore, when I am investing in an index fund, I am essentially allocating my capital intelligently by diversifying across many different businesses in a region or in a sector. Therefore, I am not betting on the performance of a single company, but the performance of a whole sector, or let's say a country or region. And the third important insight is long-term thinking. Now, of course, in the long term, the stock market goes up. So look at the S&P 500 stock. In the long term, it goes up for sure. But in short term, there are always drops. And it means that you will benefit from investing the most if you buy in small chunks and don't invest a huge amount at once. So you invest small chunks of money over time to dollar cost average, because you don't know what is going to happen after 3 or 4 months or so, and even in 1 to 2 years. The reason is that the stock market can crash at any time, but overall, over the long term, it goes up. For example, if you have saved 10,000 US dollars over the course of, let's say, 2 years, and you invested all of it at once in the stock market, or let's say for this example in S&P 500 at this point, just imagine what you would be thinking as your investment was going down continuously during each week. And that too, when combined with the fear of media, news, and your stock purchasing app turning red, surely this will give you sleepless nights and you will ultimately sell your holdings and make your paper losses real. But on the contrary, if you had divided the same 10,000 US dollars into small chunks of 200 US dollars each and invested 2,000 US dollars each month, what would have happened? You would be buying continuously when the S&P 500 was going down and even when the market was bottoming. And the good thing is that you would be buying continuously when the market was going up again. So your first 200 US dollars which you invested over here are recovered, and every dollar which you invested on the way down is now in profit, and every dollar which you invested on the way up is also giving you the profit. How amazing is that? That is why investors like Warren Buffett emphasize on the power of compounding and long-term investing. So in the same interview of Warren Buffett, the lady mentions investing in long-term.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had we've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
So the point which Warren emphasized is that the businesses and also economies of nations are resilient and survive the short-term events. So essentially, when you invest in index funds, which tracks the performance of large companies in a region or sector like the S&P 500, which is just one type of index fund, you are not just betting on the performance of a single company, but on the performance of national economies in totality. So we are betting that the economy of a country will continue to grow. So he mentioned that during his life, the markets have been through a lot of events of enormous magnitude, and those investors who had a long-term perspective in mind created enormous generational wealth. And the fourth insight is detach your emotions from investing. So one of the most important things which separates the savvy investors from newbies is the emotional control and awareness of market psychology. We already covered the importance of long-term perspective, but handling our emotions, especially fear of missing out and the urgency to invest, is very important. In turbulent times and market crashes, if there is one thing that separates the average investors from savvy investors, is the emotional control. The great investors respond and the average investors react to market conditions. So when market crashes happen, people become very stressed and sell their stocks. In this way, they make their paper losses real, and as I mentioned before, if they are well diversified by investing in an index fund, we saw that eventually the market will recover. During the market crash, the barrage of negative news, the fear projected by the media and so on can make us believe that we will lose all our money and we must sell our stocks to stop further loss of capital. As the emotions of retail or non-savvy investors motivate them to sell, the savvy investors are waiting for the price in the form of cheap shares and accumulate them. That is why Warren Buffett says, be fearful when others are greedy and greedy only when others are fearful. So according to Warren Buffett, yet another problem is the opposite one, meaning the retail investors buy when the prices are high and the people as well as media are talking about the gains which a certain stock has made over the past year or months. The average investors get something called FOMO, which is fear of missing out, meaning the positive news of media and overall positive sentiment of bloggers and YouTubers make them think that they must not miss out and must invest. And honestly, they think that the price will keep on going up, which at that point is already quite high. And that is the very reason that media talks about it in a positive way. Remember that media makes money when you pay attention and when you spend your time reading the news or looking at the television screen to see the news. So you and only you are responsible for doing the research and making a strategic plan for long-term investing success. You must own your decision and you must take full responsibility for your actions. So the conclusion is that we must not take financial decisions based on emotions and detach our emotions from investing. By doing so, you will take your investing game to the next level. And the fifth insight is value investing over speculation. So this is one of the simplest rules that is most overlooked by the new investors. The obsession with the daily price movements and weekly stock market news, which gives them a dopamine rush and a temptation to trade, makes it irresistible for them to just keep the phone aside, and after looking at the price chart for a few days, they finally invest. Having said that, this sort of short-term trading can end up in revenge trading and spiral into loss after loss, and before you know, you can lose a lot of capital. And not only that, it will also affect your well-being. So my advice to the new investors is that they should look at the charts over long term and also understand the power of compounding and dollar cost averaging. I personally talk a lot about these concepts from time to time when I analyze the stocks of different companies from a value investment centric perspective. So be sure to check out my videos about the stock analysis of different companies. So as an investor, if you are attached to the short-term price movements, your decisions will be based on them, and I have made several investing mistakes due to that. So in my opinion, it will lead to worse returns, and that is why Warren Buffett says, only buy something if you would be perfectly happy to hold it if the market shut down for 10 years. And the sixth most important insight is learn the game first. And this is the most important lesson which I have learned. So we must learn the game first and equip ourselves with the knowledge that will help us in our investment journey. Just imagine, would you ever visit a dentist who has not been to a medical school? So why would you risk your money without having any knowledge about investing and without having any idea about the way great investors think and shape their investment portfolios? No, I'm not saying that for investing you definitely need to have a degree in finance or something similar. The point which I'm about to make is that you should have a good knowledge of evaluating a company before buying its stocks. You should think like a business owner, since investing in stocks is just like becoming a part owner of a company. But with a lot of investment apps available nowadays where you can invest with the click of a button, I am really surprised to see that the majority of investors don't have any knowledge of even the basics of investing. And this leads to the loss of capital and stress, and I strongly recommend that you have at least some basic knowledge of the important ratios such as the PE ratio, which tells us how much we are paying for the stock as compared to its earning as a small part of the company. Also, you need to know some other important things like the increase of gross and net revenue of the company as well as its free cash flow over the past 3, 5 or 10 years. These numbers will tell you how efficient the company is in creating value for its targeted market or customers. Also, another important metric is the return on equity, which helps us in measuring how efficient a business is at generating profits. So you need to understand these numbers, and on this channel when I analyze stocks, I look at these numbers and also go through some important information and insights from time to time when I analyze stocks of different companies. So I strongly recommend that you equip yourself with the knowledge of investing and also understand the main strategies used by investors like Warren Buffett so that you can develop an intuition and also understand what value investing is all about. Learn about dollar cost averaging, learn about the market cycles, and take it very seriously because this will secure your financial future. In the coming months, I will be making dedicated videos about these terms, strategies, and ratios so that they can help you in understanding them easily. I hope that this video has given you a solid overview of my lifelong lessons about investing, and I believe they will serve you in long term. I wish you all the best of luck, and I hope that you will create generational wealth by focusing on the fundamentals of investing and by applying the concepts and insights mentioned and explained in this video. Thank you very much for your time, and I will see you in the next video. Bye.